Well, it's definitely underway at the moment in terms of government making sure that, you know, Australia is focused on the economic recovery. But I think people are nervous about the consistent lockdowns that are occurring now in Sydney, previously in Melbourne. So I think there's a underlying concern around the extent of recovery and the depth of the recovery, but definitely government's doing everything possible to ensure that there is a solid recovery underway. Well, for us, you know, we cover a number of different real estate sectors, and there's really, you have to go sector by sector to really answer that particular question. You know, one of our activities is in the development and construction area, so understanding lockdowns and the effects that it may be having on the construction industry is something that we're very mindful of. Also, you know, where we have exposures to rentals, income levels that might be affected by patronage, such as hospitality could be a good example that's getting affected by various lockdowns. Again, you know, we're very mindful of looking at those situations, but it's also fair to say we take that into account when we make our investment decision, and as a result of that, we really do underwrite on the basis of knowing that there's lockdowns. You know, it's very different now, you know, in 2021 relative to what it was in March 2020 when this was less understood. So all our investment underwriting really does take into account the possibility and the risk of lockdowns. Yeah, so this is a really highly debated area, and you know, you're really into personal judgments here. But my view is that the office environment has probably now changed for the long term. And one of the legacy factors of COVID will be that people will much more work under a hybrid model of both at home and in the office, and that the office sector will be in some sort of readjustment phase that's likely to take some time for it to find a new equilibrium. And you know, one of the things that I feel in this regard is that if every tenant just gave back 10% of their available office space, then across the major cities, that's a very significant amount of office space. It doesn't sound like it when you talk about it's only 10%, but when you think about the total amount of square metres that are let in prime office across the major cities, then it equates to a lot of empty buildings when you put it into the aggregate. And I think that, you know, we should stay positive on that aspect, thinking that the economy is growing, government's ensuring that, you know, we've got good fiscal spend levels to ensure programs that keep the economy ticking over. But it will actually take time for things like the office sector to find a new equilibrium based upon, you know, the new hybrid way of working, which is well and truly occurring at the moment. This is not a hedged answer. I actually think it's a bit of both. And it really depends on the circumstance and the type of property that we're talking about. So if the situation deteriorates from where it is at the moment, then our expectation is that there'll be more fiscal dollar spend by government in order to continue to stimulate the economy. And what you would see is interest rates further reduce from where they are at the moment. And both of those factors combined would see more capital coming into the market and looking for real estate as a place to earn income that you can't otherwise earn from, say, putting cash on deposit. On the other hand, if the economy was to rally extremely hard and you had a re-emergence of inflation coming back into the market, then income levels would start to rise, rentals would start to rise, and people would pay more for property because of, you know, further types of income level. So people might see that as a total contradiction in terms of talking about the positive effect on property each way, but the reality is you have to go very property specific to determine which sectors of the market will perform better in a more negative cycle versus other sectors that will perform more positive if the economy starts to see the re-emergence of higher income levels and inflation. So to give you an example of each scenario, I would say in a falling interest rate environment, a more recessionary based environment, properties such as industrial could be a good example, where you have very long dated leases, very long dated income levels that have been all pre-agreed, that may be escalating faster than underlying inflation rates. I'd expect to perform extremely well. We have seen industrial, for a number of reasons, perform well in a more buoyant environment where you've got inflationary type pressures re-emerging. Then I would expect residential, as an example, to do quite well, non-discretionary retail to do quite well, because they're getting the effects of higher prices, higher rentals, higher patronage coming through. So you really have to go property specific to specifically answer that question. I think it's fair to say at Qualitas, we don't believe we're going to see an extreme one way or the other. So we don't believe that the economy is about to fall off a cliff from where we are at the moment, and interest rates are going substantially negative. And equally, I don't think we're about to find the re-emergence of huge levels of inflation, escalating interest rates. I feel that we're going to see a much more middle path between those two various scenarios. And I feel that as and when we're looking at underlying investments and portfolios, it's really about understanding the behaviour of the income, the rental side of the equation, and also really understanding the cost side of the particular property as well. So if it's a construction loan, really taking into account rising construction costs and how that may affect the ultimate cost of a building, or it may be just the rising interest rates and how that may affect the cost of capital and the cost of ownership of a particular property. So really, again, we have to do that on a case-by-case basis and really look at the fundamental of the properties that are being provided to Qualitas as opportunities. So we're giving a lot of weight to those factors. For us, it really, the thing we're most focused on when we look at each various sector is, one, what do we think interest rates are doing in the foreseeable future? And also, where do we think the weight of money is actually pushing into at any particular point of time as well? So for us, when we're looking at interest rates, it'll be factors such as wage rate rises, wage inflation, it'll be the level of employment, unemployment, underemployment. They're factors that always feed into our house views on where interest rates are going. If we have particular concerns, we may look to adopt a long interest rate strategy by way of fixing our various costs of capital by taking out fixed rate loans, where for us it's an equity based transaction. On the flip side, it's also about a weight of money argument. So a good example of that might be in the industrial and logistics market, where we're certainly seeing through the advent of online sales quite a strong demand for that sector of the market as well. And as you have more capital pushing into a particular segment of the market, what you also find is a greater acceptance of cap rate compression and higher values going forward. So that's a good example of how we tend to think about assets and our underwriting. Interestingly, I think that if you look at the more recent announcements made by the RBA, and I'm not sort of an RBA analyst and who sort of unpicks every last word that the governor makes. But interestingly, I think that more recently they've been at pains to say it's not about a date, it's actually about the data that is coming out. And in particular, they seem to be heavily focused on achieving an inflation rate of about 3% and also getting back to some level of employment where the level of unemployment is around 4%. And they're making it clear that they're not trying to base that on forecasts. They would actually like to see the actual numbers come through before they start to look at interest rate rises. From what I can see, there seems to be very significant momentum that has built up in the economy. I think the bounce back has been a lot stronger than most people expected, and that is coming through the data. The fact that our international borders have been closed in Australia since March of last year has meant that there's less temporary employment as well available for jobs. And in itself, that has given rise to quite a lot of wage inflation, still at modest levels, but has given rise to that type of wage inflation. So again, they're the sort of factors that we're looking at. Instinctively, it doesn't feel as if it's a runaway and interest rates are going up any time soon, but I think less focused on 2024, potentially feeling in our underwriting cases that it could be earlier than 2024, but it really is about keeping an eye on those key factors that I explained earlier as to determine a view as to whether it's going to be more in the shorter term versus the longer term.